Have you ever looked at the stock market and just felt stuck? Like you want to start, but it's all too confusing. You're not alone. Most beginners feel exactly that way. But what if I told you there's a simple, proven method that works, even in 2026? Hi everyone, welcome to Invest Easy 101. My goal here is to strip away the complexity. Today, we're talking about one of the smartest moves a new investor can make, buying index funds. And not just any funds. We're looking ahead to 2026 to find the ones that make the most sense for you right now. Why 2026? Because the investing world is changing. Interest rates, new technologies, global shifts, it all matters. But for a beginner, this change is actually good news. It levels the playing field. When you use index funds, you're not trying to outsmart the market, you're simply owning it and growing with it over time. By the end of this video, you'll have a clear list of 7 fantastic options. You'll understand not just the what, but the why. Why each fund is on this list for the year ahead. We'll even do a quick calculation to show you the real power of starting now. Let's dive in. All right, let's start our countdown with number 7. SCHD. You'll find it with the ticker symbol SCHD. Now, most of the funds on our list are about total market growth. SCHD is a bit different. It's your dividend champion. So what's a dividend? Think of it like this. When you own a piece of a really profitable company, they sometimes share a small part of those profits with you directly. That's a dividend. It's a cash payment for being an owner. SCHD is an ETF that holds only U.S. companies with a strong history of paying and, crucially, increasing those dividends over time. Why is this great for 2026? In a market where prices might go up and down, these dividend payments can provide a steadying effect. They're like small rewards that keep coming, which you can reinvest to buy even more shares. It focuses on mature, stable companies, the ones that make money year after year. The cost is incredibly low, with an expense ratio of just 0.06%. That means you keep almost all the returns. If you want part of your portfolio to be built on rock-solid cash-generating businesses, SCHD is a perfect place to start. It's not the flashiest, but it's a reliable engine for long-term wealth building. Moving up to number 6, we've got VXUS. This is our key to the world beyond the United States. The ticker is VXUS. It stands for Vanguard Total International Stock ETF. Here's a crucial idea in investing. Don't put all your eggs in one basket, and don't keep all your baskets in one country. The US market is fantastic, but it's not the only place where companies grow. VXUS gives you instant ownership in thousands of companies across Europe, Japan, Canada, Australia, and more. For 2026, this international diversification is more important than ever. Different parts of the world grow at different speeds. When one region is slow, another might be booming. By owning VXUS, you make sure your portfolio catches that global growth wherever it happens. The cost is minimal at a 0.07% expense ratio, and right now, many international stocks are valued lower than their U.S. counterparts. That doesn't guarantee higher returns, but it does mean you're buying global growth at a relatively reasonable price. It's the simplest one-step solution to going global. Now, let's add some focused growth potential. Coming in at number 5 is QQQM. This fund tracks the NASDAQ 100 index. You can find it with the ticker QQQM. What's in it? Think of the biggest names driving innovation: Apple, Microsoft, Amazon, Nvidia, and Tesla. These are 100 of the largest non-financial companies listed on the NASDAQ exchange. They're leaders in technology, consumer services, and innovation. For 2026, having some exposure to this concentrated growth engine is a strategic choice. The world is becoming more digital and tech-driven every year. This fund lets you participate directly in that trend. It's more volatile than a total market fund, but it has higher growth potential over the long run. The expense ratio is 0.15%.
It's higher than our previous funds, but you're paying for that specific high-conviction exposure. Think of QQQM not as your entire portfolio, but as a dedicated portion, maybe 10 to 20%, aimed at capturing the future. It's your portfolio's growth accelerator. At number 4, we're going deeper into the market with AVUV. This is the Avantis U.S. Small Cap Value ETF, ticker AVUV. This one sounds complex, but the idea is powerful and simple. The market is made up of giant companies, medium companies, and small companies. AVUV focuses on the smaller U.S. companies that are also considered good value, meaning their stock price looks reasonable compared to their business fundamentals. Over decades, this segment of the market has delivered excellent returns. Why include it for 2026? Because after years of big tech dominating, smaller value stocks might be poised for a strong period. It's a way to diversify within the U.S. market itself, going beyond the giant S&P 500 companies. You're investing in the potential of smaller, nimbler businesses. The expense ratio is 0.25%. It's the most expensive on our list, but it's for a targeted, academic-backed strategy. If you believe in spreading your bets across different types of companies, AVUV is a sophisticated tool to do just that. It's for the investor who wants to build a truly resilient, all-weather portfolio.
We're in the top 3. Number 3 is a foundational giant, VTI. This is the Vanguard Total Stock Market ETF. You'll find it as VTI. If the idea of researching individual stocks sounds exhausting, VTI is your answer. With one single purchase, you become a part owner of every single publicly traded company in the United States, every giant, every mid-sized firm, every small startup. You own a tiny piece of the entire American economy. Its expense ratio is a stunningly low 0.03%. For every $10,000 you invest, you pay just $3 per year in fees. That's it. The rest of the return is yours. This low cost is a massive advantage that compounds over decades. For a beginner in 2026, VTI is perhaps the single most complete one-fund solution for your U.S. investments. You get maximum diversification instantly. You're not betting on a winner, you're betting on American business as a whole to grow over time. It's simple, brilliant, and incredibly effective. The silver medal goes to a legend, VOO. This is the Vanguard S&P 500 ETF. Its ticker is VOO. The S&P 500 index is the 500 largest leading companies in America. These are the household names like Coca-Cola, Johnson & Johnson, and Visa that have shaped the modern economy. When people talk about the market, they're often talking about the S&P 500. VOO simply buys you a small slice of all 500 of these champions. Its expense ratio matches VTI at 0.03%. It's the definition of low-cost, broad market investing. The performance of these 500 companies is a powerful proxy for the health of the U.S. economy itself. For 2026, VOO remains a cornerstone. It's less volatile than a tech fund, but has more proven long-term growth potential than a dividend fund. If you want sleep easy at night investing in America's corporate leaders, look no further. It's a classic because it simply works. And now our number 1 pick for the best index fund to buy in 2026. But I have to be honest with you, for a true beginner who wants to set up a portfolio for the next 20 years, the best choice isn't one single fund. Our top recommendation is to build a simple, powerful duo using VTI and VXUS. Here's the magic. VTI gives you the entire U.S. stock market. VXUS gives you the entire stock market of the rest of the world. Combined, you own a massive, diversified slice of global capitalism. You're invested in thousands of companies across dozens of countries. The blended cost is still under 0.05%, practically nothing. For 2026, this combination is unbeatable. You're not guessing which country or sector will win next year. You're making a calm, rational bet that human innovation and economic activity will increase in value over the long term across the globe. You can adjust the ratio. Maybe you want 60% VTI and 40% VXUS, or 70% and 30%. The exact split is less important than the principle. You are globally diversified, low cost, and set for the long haul. That's the ultimate beginner's strategy. Let's pause and make this real. What does long-term growth actually look like in dollars and cents? Let's say you start in 2026. You decide to invest $100 from your paycheck every single month. You put it into that simple two-fund portfolio of VTI and VXUS. We'll use a conservative average annual return of 7%, which is below the historical stock market average. Month after month, year after year, you keep adding that $100. You're not trying to time the market, you're just being consistent. Fast forward to 2036, just 10 years later. You will have personally contributed $12,000 of your own money, but because of compound growth, your account wouldn't be worth just $12,000. Your investment could grow to over $17,000. That's an extra $5,000 created, not from extra work, but from your money patiently working for you in the best funds. This is the life-changing power of starting now. So, what's your next step? It's simple. Don't overthink it. This week, open a brokerage account if you don't have one. Names like Vanguard, Fidelity, or Charles Schwab are great places. Then, pick one fund from this list that resonates with you and make your first investment, even if it's just $50. The hardest part is starting. The second hardest part is staying consistent. Automate it if you can. Set up a monthly transfer, then forget about it and let time do its work. If this video helped you see a clear path forward, please subscribe to the channel. Every week on Invest Easy 101, we create guides just like this one, breaking down complex topics into simple, actionable steps. Hit that subscribe button and the bell icon so you never miss a video that could help your financial future. Now, I'd love to hear from you. Drop a comment below and tell me, which fund are you most excited about starting with? Is it the global duo of VTI and VXUS, the steady VOO, or the dividend power of SCHD? Let's start a conversation. Thanks so much for watching, and I'll see you in the next one.